While most people were distracted by inflation headlines, election cycles, and tech earnings, something far more mechanical shifted in the background of the metals market. It didn't trend on social media. It didn't ring an alarm bell on financial TV. But inside dealer networks and wholesale bullion desks, a rule changed. The core event is simple to state and difficult to appreciate. A growing number of physical silver dealers and distributors quietly altered delivery terms, premiums, and inventory commitments in ways that imply a future price regime far above the quoted spot market. In some cases, modeling end prices in the $60 to $84 per ounce range under stress scenarios. That number sounds dramatic only because most people anchor on today's screen price. They assume the price of silver is what a futures contract says at any moment, but the crowd misses the structural gap between paper price discovery and physical settlement reality. The futures market trades tens of billions of ounces per year in notional volume. Annual global mine supply is roughly 820 to 850 million ounces. The system works only because nearly all contracts are netted in cash. Very little metal ever changes hands. Now here's where it breaks. Dealers do not hedge on ideology, they hedge on risk. When they begin shortening delivery windows, raising non-refundable deposits, limiting bulk orders, or quoting wide callback spreads instead of firm prices, they are signaling that replacement risk is rising. Replacement risk is the cost of sourcing metal after a sale is made. If a dealer sells you 10,000 ounces at spot plus a $2 premium, and 2 weeks later wholesale bars are unavailable below spot, plus $18, the dealer eats that difference. That is the forcing mechanism, replacement risk driven by supply rigidity colliding with demand that cannot be delayed. Why now? Because silver is no longer just a monetary hedge. It is an industrial input with no close substitute at scale. Solar manufacturing alone consumed approximately 160-180 million ounces in 2024 estimates, up from under 100 million a decade ago. EVs, power electronics, and medical equipment continue to compound demand. At the same time, new mine projects require 7 to 12 years of lead time, and grades are declining. The market is not elastic. The crowd still thinks in narratives. Inflation hedge, recession trade, speculative metal. Institutions think in flows. How many ounces are moving? How many can be replaced? How fast? What's at stake is not a chart pattern. It is whether the price that clears futures exchanges can continue to clear the real-world supply chain. If that bridge fails, you don't get a smooth repricing. You get a discontinuity. Premiums detach. Availability becomes the price. This is the part most people miss. The shock does not start on a chart. It starts in back offices, in contract language, in delivery terms, in the quiet decision to stop guaranteeing metal at yesterday's assumptions. To understand why a number like $84 silver can appear inside dealer risk models without being a fantasy, you have to separate three different markets that most people mentally collapse into one: the futures market, the wholesale physical market, and the retail delivery layer. They are linked, but they are not the same system. The quoted price of silver most people see comes from futures exchanges, primarily COMEX. A standard silver futures contract represents 5,000 ounces. On an average trading day, hundreds of thousands of contracts change hands. That implies paper volume equivalent to 1 to 2 billion ounces per day. Compare that with global mine supply of roughly 850 million ounces per year. The paper market trades more silver in a week than the planet produces in 12 months. That mismatch is not a bug. It is how modern commodity markets function. Futures are designed for price discovery and risk transfer, not mass delivery. Over 95% of contracts are closed in cash or rolled forward before expiry. Only a small fraction ever results in physical settlement. As long as participants trust that physical silver is somewhere in sufficient quantity, the system remains stable. But when trust in that assumption weakens, behavior changes fast. Here's the concrete mechanism. Imagine a dealer who sells 50,000 ounces per week. Historically, they might hedge exposure by shorting 10 COMEX contracts. If wholesale bars are reliably available at spot plus 150 to 250, the hedge works. If spot rises $3, futures gains offset higher replacement cost. The spread is predictable. Now introduce two changes. Industrial demand becomes inelastic. A solar manufacturer cannot pause production because silver is expensive. A single gigawatt of solar capacity can require 20 to 25 million grams of silver. That demand is contractual and time-bound. Physical inventories decline. Exchange-registered inventories fluctuate, but what matters is deliverable, unencumbered metal. If available stocks fall from, say, 350 million ounces globally to 250 million, the buffer shrinks. In that environment, futures still trade enormous notional volume, but the optional value of real metal rises. The futures price is no longer the marginal clearing price for physical supply. It becomes a reference, not a guarantee. Dealers respond by changing contract structure. Instead of spot plus $2, delivery in 7 days, they quote, spot plus variable premium, subject to confirmation. They require 50% non-refundable deposits. They cap order size. They add force majeure clauses. These are not emotional moves. They are mathematical defenses against gap risk. Here's a simplified numerical example. Dealer sells 20,000 ounces at $26 spot plus $3 premium, Fossis 29. 2 weeks later, wholesale bars are only available at $26 spot plus $15 premium, Rossauer $41. Futures hedges protect against the $0 change in spot, but not the $12 premium expansion. The dealer loses $240,000 on a single order. Multiply that by 10 orders, and the business fails. So dealers begin to price future scarcity, not present abundance. They model scenarios where futures remain liquid, but physical supply constricts. In those models, the clearing price is not what traders think, but what forces metal out of private hands. At what price does a refinery release inventory? At what price does a government stockpile become politically acceptable to mobilize? At what price does recycling accelerate meaningfully? Those are not $30 questions. Historically, they are $60, $100 questions. This is why the shock is structural. It is not about whether silver should be worth more. It is about whether a paper market built on netting can continue to anchor a physical market facing real-world bottlenecks. The futures curve can stay calm right up until the moment it cannot bridge that gap. And when that happens, price does not glide. It jumps. Every market shock ultimately resolves through forced behavior. Not opinion, not narrative. Force. In the silver market, the pressure is building on a narrow set of actors whose business models depend on continuity between paper price and physical reality. When that continuity weakens, someone must absorb the mismatch. The first group under pressure is bullion dealers and wholesalers. Their role is to stand between buyers and the upstream supply chain. They quote firm prices, accept orders, and assume they can replace what they sell. This model only works when the spread between futures and physical remains narrow and stable. Once replacement risk becomes volatile, dealers face a binary choice: either widen terms aggressively or risk catastrophic loss. They cannot wait and see. A dealer who keeps quoting yesterday's rules while the wholesale market tightens will be arbitraged into insolvency. That is why changes appear suddenly and in parallel across the industry. Not collusion, convergent survival behavior. Next are industrial users. Solar manufacturers, electronics firms, medical device producers, and defense contractors do not treat silver as a speculative input. It is a functional material embedded in production schedules. A one-week disruption can idle factories worth billions in capital. For them, the decision matrix is stark. Either pay the marginal price or halt production. This is the first trap. Industrial buyers are structurally long silver. They cannot substitute at scale. Copper does not conduct the same way. Aluminum oxidizes. Graphene is not industrially deployable at cost. When supply tightens, these actors do not exit. They escalate. Then there are short sellers and market makers in the futures market. Many participants are not directional speculators. They provide liquidity by being short futures against inventory, ETFs, or forward flows. Their risk models assume that delivery is always possible at a bounded premium. When that assumption fails, a futures hedge becomes incomplete. If physical premiums expand by $10, $20 while spot remains flat, a short futures position offers no protection. Margin models are not designed for basis explosions. That creates a second trap: either reduce exposure by buying back shorts, or post escalating collateral against a position that no longer hedges real risk. This is where mechanical pressure emerges. Clearinghouses do not negotiate. If volatility rises, margin requirements rise. A contract that required $12,000 in margin may require $18,000 or $22,000 within days. For a fund holding 5,000 contracts, that is a $50 million liquidity call, not because the trade is wrong, but because the system demands collateral. Now add banks and custodians. They finance inventory, extend credit to dealers, and underwrite storage. When price behavior becomes discontinuous, risk committees intervene. Credit lines are reduced, haircuts increase. Inventory that once financed at 90% loan-to-value may drop to 70%. That forces liquidation or recapitalization. This is the part most people miss. The silver market is small in dollar terms, but it is embedded in a much larger credit system. A disruption in a $25–40 billion annual market can propagate into balance sheets hundreds of times larger through leverage and financing. The binary framing becomes unavoidable. Either physical supply responds through recycling, government mobilization, or demand destruction, or paper price must rise to ration access. There is no third path. A useful historical parallel is the 1979-1980 silver episode. Then, a concentrated long position collided with limited deliverable supply. Prices rose from roughly $6 to nearly $50 per ounce in under 2 years. The similarity is not the actors, it is the structure. In both cases, paper claims overwhelmed physical float. The difference today is that demand is industrial, not speculative. Factories do not take profits. In 2021, a smaller echo occurred. Retail demand surged, ETFs absorbed tens of millions of ounces, and physical premiums briefly reached $8–12 over spot while futures lagged. That was with no structural supply deficit. It was a sentiment shock. Today's setup is different. Mine supply growth is flat. Industrial demand is compounding. Inventories are finite. The pressure is not emotional. It is mechanical. And mechanical pressure does not dissipate with headlines. It resolves only when someone is forced to change behavior. Markets can argue with narratives. They cannot argue with arithmetic. The silver story becomes unavoidable once you map physical flows against structural constraints. Start with supply. Global mine production has averaged roughly 850 million ounces annually over the past several years. That number has not meaningfully grown despite higher prices at times. In fact, many major deposits are aging and average ore grades continue to decline. New projects typically require 7 to 12 years from discovery to commercial output. Even optimistic development pipelines suggest incremental growth measured in tens of millions of ounces, not hundreds. Recycling adds approximately 150 to 180 million ounces per year under normal conditions, but recycling is price-sensitive and slow-moving. At $25–30 silver, scrap flows remain muted. Meaningful acceleration historically begins closer to $50–60 when jewelry, tableware, and electronic scrap suddenly become economically attractive. So in a base environment, total annual supply, mine plus recycling, lands in a broad range of 970 to 1,030 million ounces. Now demand. Industrial usage alone has moved from roughly 450 million ounces in 2015 to an estimated 650 million ounces today. Solar accounts for 160 to 180 million ounces, electronics another 250 to 300 million, and the remainder spans medical, automotive, and defense applications. These uses are non-discretionary once capacity is built. Add jewelry and silverware demand, typically 180 to 220 million ounces. Add investment demand, coins, bars, ETFs, which varies dramatically by cycle, but has averaged 200 to 250 million ounces over the past decade, with spikes above 300 million in stress periods. That produces a demand range of approximately 1.0 to 1.2 billion ounces. Even using conservative midpoints, 1.0 billion ounces of demand against 1.0 billion of supply, the system has no buffer. In years when investment demand surges or industrial growth overshoots by even 5%, deficits appear. Those deficits do not vanish. They are filled by inventories. Above-ground silver exists in large quantities historically, but only a fraction is liquid. Much is embedded in electronics, infrastructure, or private holdings that are not price responsive below extreme levels. The floating inventory, the metal actually available to settle trades, is far smaller. Estimates vary widely, but a plausible range for globally accessible, unencumbered bullion is 200 to 400 million ounces. A 100 million ounce annual deficit erodes that buffer in 2 to 4 years. This is why the market's expectations fail. Futures pricing assumes that any shortage is temporary and correctable. The data suggests otherwise. To illustrate, consider 3 scenarios. Scenario A, stability, case supply, 1,000 million ounces. Demand, 1,000 million ounces. Inventory change, 0. This requires industrial growth to stall, recycling to remain robust, and investment demand to remain subdued. It assumes no macro stress and no policy-driven demand spike. It is mathematically fragile. Scenario B, moderate deficit supply, 990 million ounces. Demand, 1,080 million ounces. Annual deficit, 90 million ounces. This reflects modest industrial growth, 5 to 7%, steady jewelry demand, and average investment flows. At this pace, a 300 million ounce floating inventory is halved in less than 2 years. Scenario C, stress case supply, 980 million ounces. Demand, 150 million ounces. Annual deficit, 170 million ounces. This assumes accelerated solar deployment, geopolitical hedging demand, and ETF inflows similar to 2020-2021. In this environment, deliverable inventory can be exhausted within 12-18 months. The key is not which scenario is correct. The key is that none produce surplus. Once inventories become the marginal supplier, price no longer clears at the cost of production. It clears at the price required to unlock hoarded metal and induce recycling. Historically, that threshold is not linear. It is convex. Small price moves do nothing. Large moves change behavior. A rise from $25 to $35 does not mobilize private silver. A rise from $35 to $70 does. This is why dealer models begin to incorporate numbers that feel extreme relative to the present. They are not predicting, they are solving for equilibrium under constraint. When a market transitions from flow-based to stock-based clearing, expectations anchored to normal price ranges fail, not because sentiment changes, but because the math does. When a structural shortage begins to express itself in a financial market, it rarely appears as a smooth upward trend. It emerges as a series of discontinuities, gaps, freezes, premium explosions, correlation breaks that feel chaotic to observers but are mechanically logical to participants inside the system. The first transmission channel is the basis, the spread between futures prices and physical premiums. Under normal conditions, that spread is narrow and predictable. A 1-ounce coin might trade at spot plus $2 to $4. A 1,000-ounce wholesale bar might clear at spot plus $0.50 to $1.50. That relationship anchors trust. As inventories tighten, that anchor slips. Futures may remain liquid, but physical supply becomes conditional. Premiums widen in steps. $3 becomes $6, then $10, then call for quote. This is not inflation in the classical sense. It is a repricing of immediacy. The buyer is no longer paying for metal. They are paying for certainty. This divergence produces the first visible anomaly. Paper silver appears cheap, while real silver becomes expensive or unavailable. Commentators interpret this as manipulation, inefficiency, or temporary dislocation. In reality, it is the market signaling that the futures price is no longer the marginal clearing price for physical flow. The second channel is volatility. As the basis becomes unstable, risk models break. Market makers widen spreads, options markets reprice tail risk. Implied volatility rises not because traders are emotional, but because hedging costs increase. A dealer who cannot source metal at a predictable spread must embed uncertainty into every quote. That feeds into margin systems. Clearinghouses respond to higher volatility by raising collateral requirements. A silver contract that required $12,000 in initial margin may require $18,000 or more within days. Funds running large positions, especially short positions, must post additional capital immediately. This is where feedback loops begin. A fund that is structurally short futures as part of a hedging or relative value strategy now faces two problems. The hedge no longer offsets physical risk due to premium expansion. The cost of maintaining the position rises through margin calls. To reduce exposure, the fund buys back contracts. That buying pressure lifts futures prices. Rising prices increase volatility. Higher volatility triggers higher margin. Higher margin forces more covering. This is not a short squeeze in the meme stock sense. It is a balance sheet squeeze. Participants exit not because they believe a story, but because they cannot carry the position under new constraints. Simultaneously, ETFs and structured products transmit retail and institutional flows into the same constrained pipe. If investors allocate even $5 billion into silver ETFs over a quarter, that represents roughly 150-170 million ounces at $30. That volume alone can absorb an entire year's deficit under Scenario B from Chapter 4. Authorized participants must source metal. If they cannot, ETF shares trade at premiums. Arbitrage fails. The vehicle designed to smooth demand becomes an amplifier. Liquidity then fragments. Futures remain tradable, but physical markets freeze intermittently. Large orders require negotiation. Delivery windows extend. Spreads widen across geographies. London, Zurich, Shanghai, and New York decouple. The global one-price assumption breaks. To an outsider, this looks irrational. Prices spike overnight. Premiums vary wildly. Headlines contradict charts. But structurally, it is coherent. The system is repricing time and certainty under constraint. Historically, this phase is brief but violent. In oil in 2008, copper in 2021, and nickel in 2022, the pattern was similar. A long period of calm, followed by sudden air pockets where liquidity vanished and price gapped to a new regime. Observers often ask, why didn't the market see this coming? The answer is that futures markets are optimized for flow, not stock. They price marginal trades, not existential constraints. When the constraint becomes binding, the repricing is discontinuous by design. What to watch during this phase is not just spot price. It is the plumbing, the spread between wholesale bar prices and futures, ETF creation redemption activity, exchange inventory withdrawals, options implied volatility relative to realized volatility, dealer delivery lead times. These indicators reveal whether the system is transmitting stress or absorbing it. The reaction will feel emotional. It will be framed as speculation, mania, or fear. But beneath the noise, it is simply a market discovering that a price built on abundance must adjust to scarcity. Structural shocks do not unfold all at once. They move in phases: quiet constraint, visible friction, systemic response. The silver market is already in phase 1. The roadmap from here is not about predicting a single outcome. It is about understanding which path the system is taking and how quickly it is moving. Think in layers of time. Next, 24-72 hours. This window is dominated by messaging and microstructure. Watch for changes in dealer language, subject to availability, variable premium, delayed shipment. These are not marketing choices. They are early warnings. In futures, observe intraday volatility and the behavior of options. Rising implied volatility without large spot moves suggests stress in hedging, not speculation. Next, 1 to 2 weeks. This is where basis behavior becomes visible. If physical premiums continue to widen while futures remain anchored, the gap becomes narrative. ETFs may begin to trade at small but persistent premiums or discounts. Exchange inventory reports become directional rather than noisy. Next, 1-3 months. This is the decision window. Either supply adjusts or price does. Recycling flows, government releases, or industrial substitution would appear here if they are coming. If not, futures markets must begin rationing demand through price. From that structure, 3 scenarios emerge. 1. Base case: gradual repricing. In this path, physical tightness persists but does not become acute. Premiums remain elevated but bounded, perhaps $6 to $12 over spot for retail, $3 to $6 wholesale. Futures grind higher in response to sustained ETF inflows and industrial hedging. Volatility rises but remains orderly. Indicators: steady inventory drawdowns rather than sharp drops. ETF inflows measured in tens of millions of ounces per quarter, not hundreds. Options volatility drifting higher without spikes. Dealer delivery times extending moderately, 2 to 4 weeks. This scenario implies a multi-quarter adjustment where silver is repriced as a strategic input rather than a cyclical commodity. The system bends, but does not break. 2. Stress case: discontinuity. Here, a catalyst compresses time. It could be a surge in solar deployment, a geopolitical shock, or a large institutional allocation. Physical demand accelerates faster than supply can respond. Premiums jump in steps. Dealers suspend firm quotes. ETFs struggle to source metal. Futures markets respond through volatility, not smooth trend. Margin requirements rise. Short positions unwind mechanically. Price gaps. Indicators: wholesale premiums exceeding $10 over spot. Sudden inventory withdrawals in excess of 10-20 million ounces in days. ETF creation requests outpacing metal sourcing. Options implied volatility spiking above 60-70%. Exchange rule changes around settlement or delivery. In this path, price is not discovering value. It is discovering availability. The move feels irrational because it is not sentiment-driven. It is constraint-driven. 3. Relief case: structural release. This path requires an external supply response. Governments mobilize strategic stockpiles. Large industrial users forward sell inventory. Recycling flows surge meaningfully. Demand growth pauses due to macro slowdown. Indicators: announcements of state or institutional sales. Recycling volumes rising by 30-50% year over year. Industrial order cancellations or project delays. Futures curve shifting into sustained contango. Premium compression across regions. This scenario stabilizes the system without a price shock. It is possible, but it requires coordination and willingness to release metal at scale. The key insight across all 3 paths is that the market is transitioning from a flow regime to a constraint regime. In a flow regime, price is set by marginal trades. In a constraint regime, price is set by the cost of delay and the scarcity of certainty. This is why normal expectations fail. Models built on historical volatility, correlations, and mean reversion assume elasticity. They assume supply responds. When it does not, the market must reprice not just the asset, but the structure around it. Silver sits at an unusual intersection, small in market capitalization, large in industrial necessity. That makes it capable of moving faster than narratives can adapt. The story is not, silver should be higher. The story is that a market designed for abundance is being asked to operate under constraint. Systems built on netting struggle in that environment. Understanding that difference is the real edge. This content is for educational purposes only. It is not financial advice and not a recommendation to buy or sell any asset. Markets involve risk, including the risk of loss. Always consult qualified professionals before making financial decisions.